Hi there. If you felt the market is more jumpy lately, you're not imagining it. A lot of the chatter lately points to the same idea. We may be in for a choppy stretch. More headline swings, more whipsaws, more up one day and down the next. And for anyone investing for retirement, or if you already have retired, that matters for one simple reason. It's not volatility that ruins retirement plans. It's the decisions people make during volatility. So in this video, I'm going to give you a simple framework you can always use. I call it the 5-move retirement defense plan. Now, as you know, markets are not smooth. Some years are calm, some years are choppy. And every once in a while, you get a year where headlines and price swings are just relentless. So instead of trying to predict what kind of year we're in, I want you to have a simple framework you can always use no matter what happens, especially in the choppier years. All right, here are the 5 moves. Move number 1, separate money to live on from money to invest. This is the single biggest volatility advantage an investor can have, especially if you're retired or getting close. If your monthly spending depends on selling stocks this month, volatility feels like a real threat. But if your spending is covered for a while, volatility becomes just background noise. So here's the rule of thumb. First, figure out how much of your spending is not covered by reliable income, things like Social Security, a pension, or steady part-time work. Then try to keep about 12 months of that uncovered spending in cash or cash equivalents as your baseline. And if you want a bigger shock absorber, 18 to 24 months is a common sweet spot. And now if you're already retired or you're close and you want to be able to truly ignore the headlines, you can go bigger. 3 to 4 years of spending set aside as a buffer is not crazy for some people. And the reason is simple. It's designed to help you ride out not just an average downturn, but also the time it takes to recover from it. And this is especially important in the early retirement years because of sequence of returns risk. That's just a fancy way of saying if the market drops early and you're forced to sell shares to fund your life, you can permanently damage the long-term trajectory of your portfolio. A bigger buffer reduces the odds you're selling stocks when they're down. And it's not about being optimal, it's about being unshakable. The bigger the buffer, the less you care. And that buffer is your first line of defense. But here's the problem. Even with a great cash buffer, it can still be tempting to do something to your portfolio when the headlines get loud and the market drops. You start second guessing your allocation. You feel the urge to sell just to be safe. You want to jump in and out. So move number 2 is about your behavior. It's about installing your own panic brakes before the next scary day. Panic brake number 1 is a 72-hour rule. If a headline makes you want to do something major, sell some shares, change your allocation, etc., wait 72 hours. Not because you're indecisive, because you refuse to make permanent decisions in temporary fear. Panic brake number 2, no big moves on headline day. Markets often overshoot in both directions during breaking news, and your brain will too. Panic brake number 3, one metric only. During volatility, you check one thing. How many months of retirement spending are covered by your cash buffer? If your buffer is intact, your plan is intact. So before you do anything, ask yourself, do I actually need to make a move right now, or am I just reacting to the noise? Move number 3, rebalance with rules, not vibes. In volatile years, people usually fall into one of 2 traps. Trap number 1 is they panic sell after a drop. They see red, they assume it's the start of something bigger, and they sell to be safe. But what they usually end up doing is locking in losses and then watching the market bounce back up without them. Trap number 2 is the opposite. They freeze. They don't sell, but they also never rebalance. So after a big market move, like stocks dropping 15% in a hurry or ripping higher over a few months, their portfolio drifts away from the mix they actually chose. And that can quietly change the risk of the portfolio without them realizing it. For example, after a big stock drop, you can end up with less in stocks than you intended, which can make it harder to participate in the recovery. Rebalancing is simply bringing your portfolio back to your target mix. In plain English, you trim what's run up and you top up what's gotten beat up. Here's a clean way to do it. First, pick your target mix based on your situation. How close you are to retirement, whether you're taking withdrawals, how steady your income is, and how much volatility you can stomach without making a bad decision. For example, 70% stocks and 30% bonds, or 60% stocks and 40% bonds. Whatever you choose, that mix is your home base. Second, set bands around it. About 5 percentage points is common. So if your target is 70% stocks, you're okay anywhere from about 65 to 75%. Third, set a rhythm. You can check quarterly or every 6 months if you want, but for most people, you only rebalance about once a year unless you drift outside of your bands. So if stocks drop and your 70-30 turns into 64% stocks and 36% bonds, you're outside the band and that's the time to rebalance. And if stocks rip higher and your 70-30 turns into 76-24, same thing. That's it. Rules beat feelings. And move number 4, run a quick volatility stress test for hidden fragility. Most people do not need to overhaul their portfolio just because the market is choppy, but you do want to check for the 3 common fragilities that get exposed when markets do get choppy. Fragility number 1 is concentrated risk. If you're heavy in a handful of stocks or one sector, a headline can hit you way harder than the overall market. The fix is boring but powerful. Diversify over time. Make small intentional moves, not one big panic move. And fragility number 2, thinking yield equals safety. High yield does not automatically mean safe. Here's what happens in choppy markets. When investors get nervous, money tends to rush into the safest stuff and away from the riskier stuff. And that's when the high yield things get hit. Junkier bonds, leverage income funds, anything that's stretching for yield, those can drop a lot, sometimes like stocks. So just make sure your income bucket isn't secretly a risk bucket. Fragility number 3, bond risk mismatch. If bonds are supposed to stabilize your plan, make sure they actually behave like stabilizers, because some bond funds can be way more volatile than people expect. For example, long-term bond funds can swing a lot when interest rates move, and high-yield bonds, the junkier stuff, can drop when stocks drop because they're tied to credit risk. So if you bought bonds for stability, those choices can surprise you in a rough market. So here's a simple principle. If this money is meant to be your shock absorber, keep that part of your bond mix high quality and shorter term. If you want to take more risk or more yield, fine, just know that it's not your stability bucket. The point is to match the tool to the job. Align your bond choices with what you need bonds to do in your plan. And move number 5, have a down market spending plan that keeps you in control. This is where investors win or lose, especially if you're retired, about to retire, or planning early retirement. When the market is meaningfully down, your goal is simple. Don't turn a temporary drop into a permanent loss by selling stocks just to pay the bills. So here's the framework. First, use your cash buffer for spending in those down stretches. That's literally why you built it. Second, if you're in a taxable account and you want to do something productive while prices are down, consider tax-less harvesting. That's when you sell something that's down to capture the loss for tax purposes, then you reinvest so you stay in the market. And anytime you do sell in taxable, be intentional. Choose the lots you sell so you can control how much capital gain you're creating. So that's move number 5. In down markets, the cash buffer keeps you calm, and tax-less harvesting can turn volatility into something useful. Now let me close with the big mistake to avoid in choppy markets, trying to fix your portfolio in the middle of a storm. If your plan made sense before the scary day, a scary day is usually not the time to reinvent your plan. What you want is what I covered in this video: a spending buffer, panic brakes, rules-based rebalancing, a quick fragility check, and a clear down market spending plan. Because the entire point of long-term investing, including retirement planning and planning retirement spending, is this: the market can be chaotic, but you can be stable no matter what. Quick question for you. What was the biggest takeaway from this video, and which one of these 5 moves are you going to implement or tighten up first? Drop that in the comments. I do read all of them. And if you want more no-nonsense retirement and investment strategies like this, be sure to hit subscribe. And lastly, I have a freebie to share with you. Download my free early retirement checklist. It's called the 12 Must-Do Steps to Retire Sooner and Smarter. It offers a quick, practical guide to retiring early. You'll find a link to it in the description. And when you're not in the go, check out my Early Retirement Roadmap podcast, available wherever you get your podcasts. And go to mikeupland.com for all of my media and resources in one place. Thanks for watching. This is Mike Upland, early retiree in 2024 at the age of 55. Take care and make the most of today.